Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
Welcome to the Deep Dive. We're all about getting you well-informed, fast, cutting right through the noise.
That's the goal.
Today, we're plunging into, well, the pretty dynamic world of mergers and acquisitions.
Definitely dynamic, sometimes turbulent, too.
Exactly. You know, M&A often brings these images of massive deals, high-stakes stuff. But what's the reality in 2025, especially with all this global uncertainty floating around?
It's a really fascinating time. A lot of strategic recalibration going on, and our mission today is to give you that shortcut to understanding these shifts.
Right.
We want to highlight some maybe surprising facts, offer insights, and really look at how certain segments, like that crucial lower middle market, are becoming central.
And this isn't just guesswork, right? We're basing this deep dive on some solid data.
Absolutely. It comes from a comprehensive survey in Q1 2025. Really significant effort.
Okay.
They talked to 200 senior execs, multinationals, big private equity firms, major investment banks.
So the key players.
The key players. And what makes this data extra powerful, it was conducted by Mergermarket for Norton Rose Fulbright.
Right.
Crucially, they did a follow-up survey right after those big U.S. tariff announcements in early April.
Ah, okay. So they captured the before and after.
Exactly. And that second wave of responses, that's where things got, well, really interesting. It showed this incredibly rapid, dramatic reversal in sentiment.
A reversal? I thought the initial outlook was actually pretty positive.
It was surprisingly bullish, but that optimism, it got shattered almost overnight by the tariff news, forcing deal makers to, rethink everything on the fly.
Okay, let's unpack this. How did that initial optimism turn into market turbulence so quickly? What did that follow-up survey actually show?
Yeah, it was stark. So before the tariff announcement, April 2nd, over 53% expected their M&A appetite to increase.
That's pretty confident.
Very confident. But then after the tariffs, it completely flipped. Over two-thirds, 67%, said their appetite decreased. And a full quarter of those said it decreased significantly. It wasn't just a minor dip.
So a major pullback in sentiment. Raj Korea from Norton Rose Fulbright mentioned deals in flight slowing down too.
Yes, exactly. He observed the trade uncertainties that have arisen have definitely had an effect on deals. Deals in flight seem to be moving slower. So it suggests it wasn't just about future plans, it was impacting deals already in progress. A real reassessment.
That's a dramatic shift. So what does this all mean for where deal makers are putting their money now? Are they just hitting pause?
Not hitting pause entirely, but definitely a strategic pivot. Some explicitly told the surveyors they rerouted capital originally set aside for cross-border deals to domestic deals.
Okay, playing it safer. Makes sense.
Lower risk, shoring up supply chains, maybe more vertical integration closer to home.
But is everyone retreating?
No, not everyone. For some, this turmoil is actually an opportunity. We saw a quote from a managing director at a U.S. PE firm. They said, as valuations are low, we are finding targets more attractive, and so we'll continue to negotiate favorable terms for ourselves while our competitors are retreating.
Ah, the classic counter-cyclical play. Buy when others are scared.
Exactly. If you have the capital and the nerve, it can be a good time to find value.
Here's where it gets really interesting then. What about regional shifts? If cross-border is riskier, where are the deals happening? The report mentions some surprising areas gaining traction.
Yeah, despite the global jitters, some regions look quite bullish. East Asia, for instance, is projected for a significant increase. 33% predict growth there.
Okay.
Europe is also surprisingly positive. 49% expect M&A to increase there. Probably driven by internal consolidation,
Makes sense. And other bright spots.
Australia and New Zealand are expected to lead among advanced economies, which is interesting.
And the flip side, Where's activity expected to decrease?
The Middle East stands out there. 55% believe deal activity will actually decrease.
Any other regional dynamics?
Well, it's worth noting the growing ties within ASEAN and the broader Asia collaboration under RCEP, that's the huge free trade agreement.
Right.
That framework seems to be supporting internal deal flows within Asia, even as global sentiment is shaky.
And what about the types of buyers leading the charge in this new climate? Who's actually doing the deals?
We're seeing a definite dominance of domestic strategic buyers. They account for 51% globally.
So companies buying within their own country.
Exactly. They know the market, the risks, the regulations. It's even higher in emerging markets, 74% in Latin America, 61% in Africa.
And private equity.
Domestic PE is stepping up, particularly in emerging markets like South and Southeast Asia, 49% there. They're kind of filling the gap left by cautious global players.
Where are the international PE firms focusing then?
They seem to be targeting East Asia, 41%, and also the U.S. U.S. targets can be attractive for foreign buyers looking to onshore production, to avoid those tariffs.
Yeah, a strategic move there.
It's all about navigating that risk landscape.
This leads us perfectly to deal size, which is a key part of our deep dive today, especially that lower middle market. What does the Mergermarket survey say about the size of deals we should expect in 2025?
Okay, this is really, really significant. The data shows a major shift. Transactions worth between U.S. $100 million and U.S. $250 million.
Right, that lower mid-market range.
They're expected to account for the largest share of activity this year, 36% globally.
The largest share? How does that compare to before?
It's a huge contrast. In the previous study, deals up to U.S. $100 million were dominant. That was 40%. Now, the bracket's fallen to just 14%.
Wow, quite a drop for the smaller deals. What about the really big ones?
Larger deals, say over U.S. $500 million, they're expected to increase too, from 9% up to 20%. But the real story, the core emphasis, is shifting.
Towards that mid-range?
Yes. The emphasis on small cap and especially mid-cap deals, that U.S. $100 to $250 million sweet spot, is definitely increasing.
So why this recalibration? What's the strategy?
Well, it signals prudence.
Yep.
It's a move away from maybe riskier, large-scale acquisitions towards more, let's say, digestible deals, tuck-ins, strategic partnerships.
Less betting the farm.
Exactly. Companies seem to be prioritizing specific capabilities or market access rather than just broad expansion. It keeps them agile, doesn't tie up huge capital when things are uncertain.
And the report mentioned companies might refrain from pursuing majority stake deals.
Yes, that's part of it. Due to the uncertainties, taking full control might seem too risky. So these mid-sized deals, maybe for minority stakes or specific assets, become more attractive. It really makes that lower middle market the crucial segment to watch right now.
That's a fascinating recalibration. Really speaks to the current mood. Are there specific sectors driving this activity within that sweet spot?
Yeah, it seems quite focused. The top sectors for inbound cross-border M&A growth are industrials at 51%.
Okay.
And technology at 50%.
Consolidation, maybe.
Exactly. A managing director from a South African investment bank noted there will be more activity in industrials. There is consolidation potential and fewer regulatory hurdles.
Fewer hurdles, interesting. And tech, that's no surprise.
Right. So it's both established industries looking for efficiency and integration and the cutting-edge tech sector, both finding opportunities in that mid-range. Targeted growth.
Okay, switching gears slightly, but still related to tech. How is artificial intelligence shaking up the M&A landscape? It seems to be everywhere.
Oh, it absolutely is. AI is rapidly accelerating digital transformation, and M&A is a key part of that. The adoption rate is, frankly, incredible.
How so?
Over half the survey participants, 51%, said they've already acquired an AI business.
Already? Wow.
And 46% are actively looking to acquire one soon. That's up sharply from just 33% in 2024. It shows how fast dealmakers are moving on AI. It's core strategy now, not just a niche interest.
So what are dealmakers looking for in the AI space, and are they using it themselves?
Good question. When they look externally, the most attractive tech subsectors for this cross-sector M&A are cybersecurity, that's top at 65%.
Mix it.
Data analytics at 61%, and AI itself at 60%. They want these capabilities.
And internally, how are they using AI in their own deal processes?
This is also fascinating. AI isn't just a target. It's becoming a powerful tool for deal makers. A huge 77% plan to use it for financial analysis and valuation.
77%.
Yeah, and 75% for M&A documentation, 74% for identifying targets and sourcing deals.
So really automating and enhancing core M&A tasks.
Precisely. Troy Ungerman and Norton Rose Fulbright mentioned how AI can also be used to map out the operational processes of target companies to help identify synergies and dyssynergies. It's offering efficiency and insights that just weren't possible before.
Okay, so deals are shifting size, location, AI is everywhere. But how are companies actually funding these deals, especially with all the uncertainty? Is traditional financing holding up?
That's another area of pressure, actually. Financing conditions seem to be tightening. 35% of respondents globally expect M&A-related financing to become more difficult in 2025.
More difficult. That reverses previous sentiment, doesn't it?
It does, unfortunately. Getting capital is becoming, a bit trickier. And that naturally feeds back into deal structures and maybe reinforces that shift towards smaller, mid-sized deals.
So if traditional bank loans and things are tightening, what's filling the gap? Are companies just using cash?
It's a mix. Equity capital is still seen as most important by 39%, and cash reserves are next at 25%. But the really interesting story here is private credit.
Private credit. Explain that a bit for our listeners.
Sure, it's basically non-bank lending. Funds or institutions lending directly to companies.
Aye.
It's now seen as the third most important financing source, at 20%.
Okay.
And crucially, its use is expected to increase significantly. 43% globally expect to use more private credit, especially in markets with economic uncertainty.
Why the surge in private credit?
Flexibility and speed, often. Christopher Kinroll, another partner at Norton Rose Fulbright, put it well. The versatility of private credit is one of the key drivers. Classically, it was used for sponsor-backed, leveraged buyouts. But we are seeing private credit increasingly used for asset-based lending as well.
So it's adaptable.
Very adaptable. It fills a need when traditional routes are slower or less willing. It's becoming really mainstream in M&A finance.
And what about managing the inherent risks? Deals are complex, especially now. Are companies just accepting more risk?
No, definitely not. They're actively finding ways to protect themselves. And that's super clear in the soaring popularity of R&W insurance representations and warranties.
R&W, also known as W&I, warranty and indemnity. Right?
Exactly. W&I in many places outside the U.S. Think of it as a safety net for the deal. It covers financial losses if disclosures about the target turn out to be wrong after closing.
Provides some peace of mind.
Crucial peace of mind, especially now. And the numbers show it. Nearly two-thirds, 65%, expect its use to increase in 2025. 37% expect a significant increase.
So it's becoming standard practice.
It really is. It's pervasive across sectors like industrials, 46% using it, and life sciences healthcare, 45%. Marshall Bromwich at Norton Rose Fulbright described it as the maturity of the R&W sector.
Maturity meaning?
Meaning more competition, better rates, more specialist providers globally. It's just a standard part of the toolkit now for de-risking deals, particularly helpful in that lower middle market where diligence might sometimes be, less extensive.
Okay, beyond market stuff and financing, what about regulatory hurdles? That always seems like a moving target for deal makers. What are the big concerns in 2025?
Yeah, regulation is always top of mind. Globally, the biggest concerns right now seem to be data protection rules and antitrust rules.
Data protection and competition law.
Right. Each got nearly a third of the top 2 votes globally, but there are definitely regional flavors.
Like what?
Well, antitrust concerns are particularly high in the U.S., 78% flagged it, whereas in Europe, ESG, environmental, social, governance, and climate change regulations are seen as having a more significant impact.
Reflecting policy priorities there.
Exactly. And in Africa, a PE firm managing partner noted that foreign investments and subsidies face particular scrutiny from regulators.
Yeah.
So you have to know the local landscape.
It's a complex web. So, bringing it all together then, amidst the tariff impact, the financing squeeze, the regulatory maze, what are the biggest overall obstacles? What's actually stopping deals getting done?
Well, the most frequently cited obstacles were pretty fundamental. Supply chain risks, local economic risk, and the lack or increased cost of financing, each mentioned by 41% globally.
Basic operational and financial headwinds.
Pretty much. Geopolitical risk is also huge, especially in East Asia, 57% cited it there. And then you still have those persistent valuation gaps.
Yes, the buyer-seller price disagreement. Still an issue.
Still definitely an issue, noted particularly in Europe this time. Sellers may be remembering higher valuations from a year or two ago. Buyers looking at current risks and costs. It creates a gap.
So how are dealmakers bridging those stubborn valuation gaps if strategic deals still need to happen?
They're getting creative with deal structures. We're seeing an increasing use of earnouts and deferred payments.
Burnouts, meaning the seller gets more money later if the business performs well.
Exactly. The buyer pays some upfront, and the rest is contingent on hitting future performance targets. It aligns incentives and bridges the gap. The buyer mitigates risk. The seller can still get their price if they're confident in the future.
A pragmatic solution.
Very pragmatic. Raj Korea summed it up. When you're doing M&A, you're really valuing future cash flows. Strategic deals still need to get done, so you will see more deferred structures being used. There's definitely an element of that creeping in already.
Patience and pragmatism seem to be the watchwords.
I think that captures the mood perfectly.
Okay, what a journey through the M&A landscape of 2025. Let's quickly recap the main themes we've covered.
Sounds good.
We saw that huge impact from the U.S. tariff announcements, really reversing initial optimism and pushing dealmakers towards domestic deals or specific regions like East Asia and Europe.
Right. And we talked about the incredible acceleration of AI, both as an acquisition target and as a tool transforming how deals actually get done. Analysis, documents, sourcing.
Then there's finance and traditional sources tightening up, leading to the significant rise of alternatives like private credit, offering much-needed flexibility.
And don't forget risk mitigation. That surge in R&W or W&I insurance is crucial, showing how deal makers are actively managing uncertainty. Plus the complex regulatory landscape, different pressures in different regions.
Absolutely. And maybe the most critical takeaway, drawing straight from that Mergermarket survey, is how deal makers are responding overall, with prudence, pragmatism, and patience.
It's not just about chasing the biggest headline deal anymore. It's about careful strategic moves, long-term value, maybe vertical integration.
And central to that, as we emphasized, is the shift in deal size. That heightened focus on the U.S. $100 million to U.S. $250 million range, the lower middle market sweet spot, and the mid-cap segment generally.
Yes, that shift is key. It reflects a strategic decision to minimize risk, acquire very specific capabilities, and just adapt smartly to the current market realities. It's genuinely reshaping the competitive environment.
Which leads us to a final thought for you, our listener, to ponder.
Okay. As companies clearly adapt their M&A strategies for this longer-term value creation in such a volatile world, how might these very shifts in deal size, particularly the focus on the lower middle market and the changes in financing, reshape the competitive landscape?
Yeah, thinking about businesses looking to grow domestically or globally in the next few years, especially those operating in that crucial lower middle market themselves.
Will this new focus create more opportunity for them? Or does it mean more intense competition as bigger players also target that same space?
Something definitely worth thinking about. We encourage you to keep exploring these dynamic trends. Thanks so much for joining us for this deep dive.
Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.